Good morning, everyone. It's Patrease here with Real Estate and Chatting with Patrease on Fridays. I'm the broker associate for SBR Realty, and I have here with me today James Rashid from Northpointe Bank. Thank you for coming and chatting with me today, James. How are you doing?
I'm wonderful, wonderful. Thanks for asking, and thanks for having me and to share your audience, to be able to share with your audience.
Awesome sauce, and we appreciate you being here. So how long have you been working in the mortgage industry?
Actually, I've been in the mortgage industry about 20 years now. Okay, it's a great industry, and I'm happy to be involved in helping people to achieve their goals in purchasing homes. And not only that, but I'm also a proponent of having people to establish good credit to help us to be economically strengthened and empowered.
And I agree with that. I mean, we talk about real estate being the basis of everything, but it also really does open up your world to understanding your finances, understanding the benefit of having good credit and doing more with that. Most of our clients, of course, are looking to buy, and of course, some are selling. What do buyers need to do to qualify to become homeowners?
Generally, the first thing they do is contact you. They want to become a homeowner, but the first thing they really need to do is to become pre-qualified. And what I mean by pre-qualified, we need to look at their income and their assets. We need to look at their credit, okay, to see what programs are available for them. Okay, a lot of people, first-time home buyers, like to do a minimum down of 3.5%, which is an FHA program. Okay, there's two different types of loans. One is FHA, one is conventional. A lot of conventionals but a lot of conventional programs are geared towards putting 20% down. First-time home buyers want to put down as less as possible, so they may want to go towards the FHA programs, which is only 3.5% down. The difference between conventional and FHA and the 20% down and the 3.5% down, there's something called mortgage insurance. Mortgage insurance is to protect the bank. It's not to protect the consumer, but it's to protect the bank in case the consumer defaults in the mortgage. Mortgage insurance would then pay the bank, and then the FHA would take the home, the government would take the home, and they would become a HUD home. But again, mortgage insurance is to protect the bank. If you go conventional and you're putting down 20%, you do not have to pay mortgage insurance. That 20% is basically their insurance policy, because if you're buying a home, as an example, and it's just for multiplication purposes, 200,000, put down 20%, that's 40,000. They're lending you 160. If they had to take the home back and they sold it for 200, they made a cool 40,000. Okay, so that's what mortgage insurance is. With FHA, no matter if you put down 10%, 5%, with FHA, you're going to always have mortgage insurance for the life of the loan. Now, some people will tell you, when you go to cookouts, when you go to Thanksgiving, oh yeah, the mortgage insurance just drop automatically. That used to be the case 10 years ago, but that's not the case anymore with FHA.
Yeah.
So what you have to do, and I always tell people, sure, get the FHA, and then once you get equity, we can refinance you to drop the mortgage insurance, refinance you to a conventional loan. So I just want to basically explain that to people about mortgage insurance. Now you can get mortgage insurance with conventional, and we could put 10% down or 5% down if you qualify for a conventional loan. And with conventional, your credit score got to be much higher, up in the 700s, 720s. And again, first-time home buyers, sometimes the credit scores are in the 600, 620. Yeah. We go down to 620.
Okay.
I just want to let people know that with FHA programs, we go down to 620. With VA programs, we go down to 620. And you're in luck if you're dealing with me, because I also am certified with Freddie Mac. I just completed a Credit Smart program, which I think there's someone in your office also who was also a part of that. But I've been working with people with credit for 20 years. So I do credit advisory, and I help people to understand how they can boost their credit score or get the credit score up to where it needs to be, to the requirements that we need to be. So again, all that being said, I know you just asked one question, but I just get overloaded with word, whatever.
No, I mean that's the joy of being in this field. We gain so much knowledge, and you want people to be as informed. And because you're passionate about it, it just pours out of you. But the two key points that you shared today, which I think are important, is with Northpointe Bank, there's an opportunity for first-time buyers to use that 3.5% down FHA loan and be at a credit score of 620 as your starting point.
Sure.
As well as conventional loans that you guys do, where you may potentially be closer to a 700.
Exactly.
Credit rating.
Exactly. And my thing that I jump in to say about credit is, we want to be able to take advantage of the opportunity that's afforded us when you do have credit. Okay. And what I mean by that is, I don't suggest anybody make an interest payment. Okay. You can borrow $2,000 or $3,000 a month from a credit card, pay them off at the end of the month because you're using that money anyway. And then they're going to give you a bonus for using that money. Don't be one of the consumers that you're paying interest, because they're making billions of dollars off of millions of people paying that little interest. So when we start to think like that, now we can see how empowered we are, and we're getting paid to do that. So that's just a little tidbit. It has nothing to do with mortgages, has to do with us, us. And hopefully we can grow to that level and also help our children to understand how to use the system instead of having the system exploit us.
Well, going into,
let's get back to mortgages.
Well, no, I mean, that's fantastic points to have. I wanted to ask for those homeowners who have been affected by COVID, they're behind on their mortgage. What are some of the options that you're seeing banks have for those sellers or for those homeowners currently?
Well, years ago they had modifications. Okay, people getting modifications. When Obama was the president, they were doing bailouts out for the banks, and then they were doing modifications. Now what they're doing is people who are affected by COVID, who may have lost their job or who've become behind for whatever reason may be, whatever your circumstance is, some banks are offering to delay your payment for 12 months. Some of them are saying, okay, at the end of 12 months, you can put that delinquency at the end of the mortgage. I think it's really important to understand what the options are, because different banks are offering different options. So they're saying that you can put it at the end, or they can say that you can pay within 3 months. So it's good to look at the options that the banks are offering and understand the fine line. Because I've seen people who come to the end of the 1 year, and that loan was sold to another bank or another servicing provider, and that servicing provider says, wait a minute, you owe us $23,000. And they're like, wait a minute, that's not what the original contract said. And let's go back and read that original contract. So you really got to look at the what it is that specific bank is offering. But those are some of the options. I mean, if you can pay, then pay. But if you do need a reprieve where you have to put it at the end of the loan, then you can do that. Some people will put it at the end of the loan. Some people will go to the second option of paying it over a period of delinquency, that is, paying it over a period of 2 years. That could be another option. And then you also have to remember, if you do that, you may have a limited time of when you can refinance. Because some people saying, okay, well, let me refinance and get it, roll back into my mortgage and start all over, because rates are very low. Rates are very low. So those are several options, and I would suggest that you review that with your accountant or your attorney or someone like myself. I'm not in the modification business, but I probably could tell you what to look out for, or to give you some high points or low points about what you're getting into. So those are some of the options that you want to do when, if you were ever affected by COVID. But take a very careful look at what they are offering. And I did mention rates are low. Rates are very low, at all-time low. But because of the administration, or as an effect of the, as a result of the administration change, rates are starting to creep up. Okay, right now we're very busy because people are purchasing home, and then everybody's trying to refinance as well. because rates are so low. So now is the best time to refinance, because if you can get money at 2.875%, that's crazy money. That's crazy interest that you're getting on that. So people are refinancing, whether they're taking cash out, whether they're making home improvements, because other places that you go with interest rates, they could be 17, 18%. Here you're getting this money for 2.875, but they're also creeping up. Now it's going to 3.125. It's going to, I don't know, I have a crystal ball, but I think rates are going to continue to rise. So now is a good time to refinance. Some people are selling their homes, and now is also a good time this is a seller's market. A lot of people are purchasing homes even above asking prices, because some people want to move out of certain areas and move to New Jersey or coming from different states, and because of COVID.
Yeah.
So COVID has affected people in a lot of different ways. So those people who are looking to move to this area, they're paying over the asking prices in some cases, not all cases.
Yeah.
So that's why it's good to have realtors like you that knows the market, knows what can be offered, what shouldn't be offered. So now it's a good time to refinance, and we're so busy. And it's also a good time for those to sell. So it depends on the person, the area, and it's good to have professionals like you. And every loan is different. Now, to tell people that it's just like your fingerprint. Every credit is different. Every loan is different. All your clients are different. You can't say, "Oh, my cousin Bob just did this, so I want that." So, I'm glad that you're able to share this information, and hopefully, people will use you and your services as well as my services to help them to make an informed decision.
Certainly. And I truly do appreciate you taking this time to just talk about a few things, for first-time buyers, taking advantage of the lower interest rate, even though it's a little higher than what it's been in the past year, but it's still lower than it was when I bought a house. When I bought a house, I was like paying 4.75 on my interest rate. And now they're like, when helping some of our clients close, they got like a 2.75. And I'm like, oh,
yes,
my God.
Yes.
So it is amazing. And then for sellers who've been affected by COVID, talking to their lenders about, or talking to their mortgage company about what options they have for extending that payment period if they need it. But also, because it's a seller's market, because the values are really high right now, sellers have the opportunity to still cash out on that equity if it's there. But knowing that they have options is the most important thing. So truly, I appreciate you coming on and talking with me today, James. And I look forward to working with you again. How do people connect with you if they're interested in working with you?
They can reach me by email at james.rashid@northpointe.com. That's JAMES.RASHID Northpointe.com. James Rashid, Northpointe.com. My cell number is 908-230-5415. Also, an alternate email address is jamesjrashid@aol.com. Hit me up at any time, any question that you may have. Also, just one last point about rates, because a lot of people get confused with rates. Sometimes you'll see that conventional rates are higher than FHA rates. And you're like, well, that doesn't make any sense. I mean, I got good credit score, conventional. Well, they're going under the premise that with conventional, if you're putting down 20%, you don't pay mortgage insurance. So even if you're paying a 3.25 or 3.125 interest rate with conventional, with FHA, you may be paying a 2.875, but your payment is going to be lower with conventional because there's no mortgage insurance. So don't get confused. I always tell people, you can talk to people at Thanksgiving or at cookouts and, get some answers, but come to a professional with the answers. You don't go to a dentist for an earache, Get it from the source. People like yourself and myself, that's why we're offering these service. Nothing is free, but we're giving out this information because it's going to be vital to you. And we're not looking to get paid for the information that we're sharing, even though we hope that you use our services. We're here, we want to educate you to help you make the best informed decision.
And I agree. It's all, go to the professionals, because this is just like any other profession. Doctors study for years to be able to treat you. And it's the same thing, real estate brokerage, real estate associates, they study for hours to make sure that they're educating you to the best of their ability. And we continually are being educated. It's the same thing, I'm sure, for the mortgage industry too.
Exactly.
Okay. Well,
any last questions that you have, or are you good?
No, this is, I really, again, appreciate your time. I appreciate the knowledge you have shared today. And I know that it's going to help someone with the next steps that they need to take, whether it's refinancing, selling, or for those first-time buyers. And I'm hoping this is a great opportunity for us to both help more people.
Okay, Patrease, happy Friday, and thank you as well.
Happy Friday to you too.
Okay, take care.